$1,800, $1,900, $2,000. Nice. Thanks, President Trump. Stimulus checks are back, baby. So President Trump just announced what he's calling the tariff dividend. It's a payment of at least $2,000 per American. That's right. At least $2,000 per person is going to go out to about 85% of U.S. adults. So we're talking about potentially $400 billion or more being handed out, all while the United States is about to hit $40 trillion in debt. So what does this mean for your wallet, for inflation, and for the markets? Let's break this down. Okay, so if you remember the last big stimulus that was in March of 2021, that was $1,400 per person. So back then, full payments went to singles making up to $75,000, heads of household up to $112,500, married couples up to $150,000, and then now in 2025, we're likely going to see the same cutoffs. So if you take a look at this tweet right here, this is from Donald Trump about a few days ago. People that are against tariffs are fools. We are now the richest, most respected country in the world with almost no inflation and a record stock market price. 401ks are higher than ever. Well, 401ks are highest ever, excuse me. We are taking in trillions of dollars and will soon begin paying down our enormous debt, $37 trillion. Record investment in the USA, plants and factories going up all over the place, a dividend of at least $2,000 a person, not including high-income people, will be paid to everybody. Everybody is getting rich, right? If everyone's a millionaire, no one's a millionaire. So in 2025, we're most likely going to see the same cutoffs. That means roughly 220 million adults qualify based on those old numbers. So if you multiply that by $2,000 and you're looking at $440 billion in total. So keep in mind, Trump said at least $2,000, so this could end up being even bigger. But here's where it gets interesting. The wealth gap is at record highs. We all kind of know that. We all kind of feel that. In quarter 2, 2025, the top 10% of earners accounted for almost half of all U.S. consumer spending. I'll show that to you right here. So you can see high-income Americans are behind roughly half of all U.S. consumer spending, up from about a third in the early 1990s. So if you look at the early 1990s, you're at about 35%. Right now, you're almost at 50%. I'm going to get to this chart here just in a second. I think it's pretty interesting to spend some time there. But again, this is the highest share since 1989. So the argument here is stimulus checks, they help the bottom 90% spend more, which is supposedly supposed to boost GDP and short-term growth. But there is a catch, a big one that we've been talking about a long time on this channel. But before I get into that, I do want to break down this chart. I think it's pretty well done. So this is U.S. individual income distribution for 2024. Basically, each bar represents 1% of U.S. workers. So you have basically 0 to the 99 or 100%, if you will. And that basically varies heavily by location. If you're going to determine your class, obviously where you live, your lifestyle, things like that. But the sources are right here. So if you look at the percentages and how they're broken down. So 20% of the population would be considered poor. Okay, that's basically zero income to about $23,000 a year. And then 40% of the population is considered working class. That would be about, let's call it $24,000 a year to $62,000. You have middle class from about, low mid 60s to about 100,000. And then you have a few bars right here of the lower upper middle class, basically getting you to that 85% that we talked about earlier in the video. So again, this is everyone that would be getting that quote unquote tariff dividend. So the big elephant in the room is the inflation trap. So if you remember 2021, stimulus checks hit the economy hard, and a year later, inflation hit nearly 10%. If you look at this red arrow right here, this is the highest since 1980s. So once that money gets spent, the short-term sugar high, I have 2 little kids, and Halloween was a few weeks ago. So once that sugar high wears off and prices stay high, we're already going to see more and more inflation, in my humble opinion. We're already at 3% today. So now we're pouring more gas on the fire. Meanwhile, the Fed, they've already started cutting rates. So we had 50 basis points in September, and there's going to be another 50 since then, I think. And they're starting to say we're not going to cut in a couple months here. But you never know, right? It may be a smaller cut or it may be nothing. But either way, we've got rate cuts, we've got record high markets, and we have $400 billion in fresh stimulus. So that's a recipe, in my opinion, for more inflation and more asset bubbles, okay? So if you look at this chart right here, you can see 2020, pandemic begins, stimulus check 1, stimulus check 2, stimulus check 3, and then basically in summer of 2022, Inflation is nearing 10%. Again, the highest since 1980s. Yes, it has fallen dramatically, basically a year from then to the summer of 2023. And it has been falling pretty precipitously since then to about 2025, but it has been ticking up, and now the tariff dividend is announced. So I'm interested to see what happens after this red arrow. However, the math does not add up, okay? I'm going to show you this chart right here, but that's before today's sponsor. Thanks to today's video sponsor, Liberty Defense Holdings. Liberty is a leader in next-generation walk-through threat detection, and they're commercializing airport security technology that comes directly out of major U.S. government partnerships. We're talking about exclusive licenses from places like MIT's Lincoln Laboratory and the Pacific Northwest National Laboratory, some of the most advanced research institutions in the world. Here are 3 reasons why this company deserves a deeper look. Reason 1 is detection of non-metallic threats. Liberty's flagship system called HexWave uses advanced millimeter wave imaging and AI to detect both metallic and non-metallic concealed threats. This is a huge deal because traditional metal detectors miss modern risks like 3D printed ghost guns, plastic explosives, and other advanced materials. HexWave also screens a ton of people quickly. High throughput, minimal friction, no taking off jackets, shoes, or half your wardrobe. It's built for the real world. Reason number 2, TSA mandates and sole source contracts. By April 2026, the TSA will require 100% screening of airport employees for explosive threats. Airports started deploying HexWave in 2024 to meet that mandate. On top of that, the TSA awarded Liberty a sole source contract and roughly $6 million in grants to upgrade existing AIT scanners. These are the same full-body scanners we already walk through at airports today. That upgrade kit represents a potential $100 million retrofit market. And that's significant because Liberty's entire market cap is only about $16 million US. If they land even a portion of that $100 million retrofit opportunity, the upside could be enormous. Reason number 3 is a low valuation setup. Despite raising $45 million for product development and commercialization, Liberty Defense shares are still trading near their all-time lows. So from a valuation standpoint, you have a tiny market cap, government-level technology, and multiple large catalysts on the horizon. If you want to learn more about Liberty Defense Holdings, check out the link in the description below. So Trump says the tariffs will fund these checks and that any leftover tariff revenue is going to go towards paying down the debt. So if you look at our debt right here, you can see that we've added $10 trillion in just 5 years. So again, as I've been saying for years, our lizard brains can't possibly comprehend how big of a number 1 trillion is, let alone 10 trillion, okay? So this sounds good on paper, but here's the reality. In August, the U.S. government brought in $30 billion in tariff revenue. The August deficit alone was $345 billion. So tariff revenue only covers about 10% of what we're overspending every month, and we're adding $600 billion to the debt since. This is since October 1st. So this total debt is closing in on 40 trillion, you guys. That is not sustainable. But if you read certain books like The Deficit Myth, talking about modern monetary theory, they say it is sustainable. But we all know more introduction of currency units in the system is going to lead to one thing, right? Inflation, right? That is the textbook definition of inflation. You're introducing more currency units into the system. What do you think it's going to do to the value of the dollar? So what are the market implications and takeaways? What's the point of this entire video? So despite everything that I've just told you, the S&P 500 is only 3% below all-time highs and up 35% since April. So take a look at this screenshot right here. Yes, tech has been getting crushed the last couple of days, but it is rebounding. I think we're just, we're going to see some pain. It can't just keep going up and to the right. But this market loves liquidity, aka money, okay? More currency units. This is pure liquidity. Meanwhile, tech companies are spending like $200 billion a quarter on AI-related CapEx. If you guys are following Michael Burry, he basically just shut down Scion Capital Management, or his fund, whatever it's called. But basically, he doesn't believe in a lot of the ways the accounting is working and the depreciation is being written or underwritten. So the AI boom, yes, it's driving growth, but is it a bubble? I know some, I think it was JP Morgan or Bank of America, I can't remember, or Citibank. Sorry, I haven't slept. I have 2 little kids. I'm like running on fumes. But basically, they surveyed portfolio managers, and I think half of them said they think that this is an AI bubble, at least in the short term. So in the short term, we are seeing asset prices again, 3% away from all-time highs. But in the long term, what is this going to do? This is just another involuntary tax, in my opinion. You might get a $2,000 check today, but you're going to pay it back and more through higher prices tomorrow, aka inflation. So what should you do? Obviously, own assets. That's what I've been preaching on this channel for years, because inflation is going to punish savers. Remember, savers are losers. If you put your cash under your mattress or put it in your drywall, what do you think it's going to buy 50 years from now? Nothing. Do you think there's going to be cash 50 years from now? You're kidding yourself. So anyway, stocks, real estate, Bitcoin, productive assets, land, productive businesses, those are the things that you want to own to stay ahead, okay? So again, own assets. So what do you think? Is this tariff dividend smart policy, or is it just like another short-term sugar rush before the next inflation wave? Let me know down below. And as always, you guys, thank you so much for watching and staying until the end. These videos take a lot of time and research to make, and I appreciate you staying and listening to me blab into this microphone and camera. Thank you so much, everybody. Have a prosperous day. Nice. I can't wait to see what this stimulus check gets me. Okay, here's $2,000, Mr. Cashier. What do I get? Oh, and nice. Oh, and this is purified water. This is not even spring water. It was for a kid's birthday party. Sorry, this is not a good joke. Actually, I'm really thirsty though. All right, see you guys.